Right now, the Chinese economy is like a sinking ship threatening to take down the global economy in its wake. And while China is the world's second largest economy, it's also one of the most indebted large economies in the world, with its state-owned banks perched on mountains of bad debt. And that's just on the surface. Underneath are trillions of dollars in murky off-balance sheet lending that threatens to destabilize China and the world's economies. The debt in China's economy extends to personal, corporate, and government levels. Defaults by Chinese borrowers have surged to record highs, highlighting the depth of the country's economic downturn, and more than 8 million Chinese citizens have been blacklisted by the government for missing payments. This situation has worsened in China by a staggering unemployment figure of over 21%. Now, the government's response to growing personal debt was simply to stop reporting the data. And they're slow to pass regulation to help the situation because they fear that corruption within the system may be revealed and come to light. And a larger issue is that the government debt is also skyrocketing and China's economic growth is slowing, and soon local governments will start defaulting on interest and principal payments. Most commercial banks are state-owned and they often make their decisions based on government decree rather than economic pragmatism. And this includes making risky loans to state-controlled companies. Official bad loans at Chinese banks hit $540 billion in 2020. Now, cities and provinces across the country have accumulated a massive amount of hidden debt following years of unchecked borrowing and spending. The IMF and Wall Street banks estimate the total outstanding off-balance sheet government debt is between $7 trillion and $11 trillion, and a significant portion of this debt is at high risk of default. Now, in order to get non-performing loans off the bank's balance sheets, they're often bundled and sold to investors, and this is really the exact same problem that caused the Great Financial Crisis in 2008. A wave of local bank defaults could spread losses far and wide, and it could quickly snowball into a nationwide financial crisis. Credit markets could seize up and banks could start failing across the country. Moody's Investor Services lowered its outlook on Chinese credit rating to negative from stable, and they pointed to the central government needing to bail out local government debt and the country's slowing economic growth. Now, China has also experienced a year-long property bust and dozens of real estate defaults. Local governments and banks are being put at the greatest risk of collapse since they are the ones that funded the majority of the projects. But local governments, however, are still under pressure to stimulate growth, and they're still borrowing heavily. In fact, their outstanding debt has actually doubled since 2018. Now, much of China's record growth was fueled by debt, and with the bill coming due, China's economy is rapidly sinking, and with our highly connected world economy, China's demise can have severe consequences for the US and significantly impact stock-based retirement funds. Reduced demand for goods and services from China will directly affect US companies reliant on exports to the country, impacting their revenue streams. Now, additionally, intricate supply chains involving Chinese components may face major disruptions, hampering production capabilities within the US. And moreover, a slowdown in China's economy might decrease the demand for commodities, adversely affecting US energy and commodity sectors. Investor uncertainty fueled by these events can spike market volatility and incite investors to offload stocks, further impacting market stability. And financial institutions with Chinese investments might undergo stress, potentially affecting US financial sectors. And furthermore, the depreciation of the yuan could instigate currency market instability. But as of now, US pension funds, individuals, and institutional investors are on the hook for $2.1 trillion in Chinese companies listed on American exchanges. Holders of China's foreign currency debt are also at risk of losing $2.4 trillion. China's economic chaos will eventually wash up onto our shores, and before it does, investors would be wise to hedge their portfolios into tangible assets like precious metals. And if you're concerned about the economy, if you're looking for a way to reduce the risk, I'm Murky with American Hartford Gold. Give us a call today, and we'll discuss how putting physical precious metals into your portfolio can give you the protection that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.